Hey traders, this is Blake Morrow with Trader Summit. And with me today on the very last interview of 2022, I have the pleasure of meeting with Jim Welsh from Macro Tides. How are you, Jim?
I'm good, and I want to wish you and everyone tuning in a happy and healthy 2023. And we're going to do our best to make it profitable.
Yes, and help. And you know what you've done a really great job of this year, Jim, is really helping navigate all the traders and investors through, this very, very volatile year. And it's been chock full of volatility this entire year. What do you think?
Well, we're going to see more.
So that's what's in store for 2023, right?
Yeah, there's no epilogue here yet, and I think, one of the themes that we've had this year, pretty ongoing, was Wall Street misunderstanding, not listening to what the Fed was telling them they were going to do. And, there'd be, rallies in the S&P, and then it's like, oh, wait a second. They are actually going to do what they said they were going to do. That's going to continue, I think, in the first half, at least, of 2023, Blake, and we're going to cover some of that in a minute or two.
All right. Well, sounds great. Well, Jim, speaking of which, here we are at the very end of 2022. And it looks like, interest rates, by the Fed, we're getting to that, terminal rate. I mean, yeah. Do we say that? I mean, we're getting to that point where rates could go almost at this point, they could start going either way, but will they just stay the same? And I know the first chart that you brought for us is the dot plot. So what is this telling you as an investor and as a trader of the markets, what to expect going into next year?
Well, I think there's a lot of information here. A lot of times the dot plots are like, oh, okay. This is from the December 14th meeting. And what you can see is for 2023, so you can look at the bottom and see which year you're in. The spread is 75 basis points from the high to low. So the dots are unusually packed together. The median is for 5.1%. 17 of the 19 people submitting dots were at 5% or higher. So what that tells me is that the continuation of what we've seen in the last 6 to 8 months, where the FOMC members are all on the same page when they go out and give interviews and speeches, they're all delivering the same message. That is going to continue, I think, into the first half of next year. And that message is going to be, we're going to raise, especially in the next few weeks, we're going to raise the funds rate a little bit more. Then we're going to hold it all the way through 2023 at that restrictive level. So Powell has said, there is no formula for what is the restrictive level. They're kind of feeling their way. I think they'll go 50 basis points at the February 1st meeting, and then maybe a quarter at the March 22nd meeting and so forth. But the point being is, after we get into the new year and they start giving speeches in a week or so, we're going to hear that message delivered on and on. The dot plot for 2024 widened out to 150 basis points. So what does that tell me? Well, sometime, late third quarter, fourth quarter, we will start to hear different messaging from different members of the FOMC. So the last 6-8 months, doves like Mary Daly from San Francisco, Neil Kashkari from Minneapolis, were almost saying the exact same things as Jim Bullard from St. Louis, who's a real hawk. So I think that is what's going to happen in the later on this in 2023, is that we will see some of the members talking about when they think it'll be appropriate to bring rates down. So that's
this is kind of takes us into this next slide you brought us here into forward guidance. So.
So
your thoughts?
I think in the first part of the first quarter, especially, there are going to be speeches that saying we're going to raise the funds rate a little bit more. We're looking for the restrictive level, and we're approaching that. Then we're going to get to the point where I think sometime early in the second quarter where it's going to be, hey, we're at the restrictive level, but we're not close to cutting rates. And I think again, the Fed funds futures have the Fed funds peaking in June and then dropping 130 basis points in the second half of 2023 and the first part of 2024. So this is the wake-up call, I think, in the second quarter for the stock market and markets in general, is that the Fed is going to stick to it, even as we get data showing that the economy is moving toward a recession, which again, I'm still in that recession camp. I never thought there would be one in 2022. I think as we get closer to mid-2023, it's going to be very likely that, okay, it's on the doorstep. And then late third quarter, early fourth quarter, you know, as the economy really does show signs of slowing, you'll see them start to say, yeah, we're going to start talking about cutting rates. They, again, in Fed speak, they never say anything specifically, but, you know, they say words that make it easy, at least, you know, for me, I've been following them a long time, to kind of read between the lines. And so to me, these are the phases, and each step along the way, the market's going to respond to this. So going on to, I think the first chart is the S&P. So as I said earlier, the market's been anticipating stuff, you know, so in June, it was like, oh, okay, the Fed is going to raise rates because we're going to go into a recession, and then they're going to bring them right down. And Powell at the late August Jackson Hole speech said, no, that's not what's going to happen. Then as we got into October, it's like, oh my gosh, they're going to, you know, they're going to hit the pause button, the market rallied. Again, no, that's not what's going to happen. So I think what we're likely to see is weakness in the first part of January, because the messaging from the FOMC members is going to be, hey, we're not doing anything, we're going to raise it some more. And I think we get the market to back off. The bottom of this chart shows the call put ratio. So and it's 10-day average. So it shows a lot of put buying has been going on. But the thing I would point out is if you look at September, October, a lot of times sentiment hits an extreme before the price low or high. And I think something similar is going to be playing out here. So we can see a lot of negative sentiment has pulled, you know, come into the market. If we decline more, it'll get more reinforced. And then I think on January 12th is the next CPI for December. There's a chance, Blake, I think a realistic chance, it will have a 6 handle, you know, like 6.9. The one for November was 7.1. Mm-hmm. And so that to me will be the trigger. Hey, the inflation is really coming down and the Fed will be able to hit pause and all that kind of stuff. And oh, it's also bullish. So that's why I think you have weakness in the early part of January. And then my expectation is that there's going to be potentially a pretty good rally that will take from whatever the low is in the early part of January above the 4,100 level and potentially pushing up towards the 4,300 level.
Wow.
We'll see.
All right. That's a hell of an expectation. Yeah.
Well, we'll see. I mean, again, the CPI has to deliver by coming in softer. The thing I would pay, the January macro tides, I'm just about done with it. And we've talked about this, is that Powell, in fact, did provide a pivot. Wall Street didn't like it. They didn't listen to it. But he pivoted away from inflation being the key determinant for policy in 2023 to the labor market. And that's why I think, you know, again, the market's going to expect the Fed to react to lower CPI information, which, again, in the first few months of next year, the CPI could be down closer to 5, maybe even under a little bit. But the Fed is looking at the labor market, and that's why they're going to hold the funds rate at the restrictive level for an extended period of time. So this is an indicator I use, 21-day net advance declines. And as you can see, as we got to the June low, there was a nice divergence, which was one of the reasons why I was looking for a rally. At the same time in September, same exact thing. Got really oversold, bounced, went to a lower price low, and that set up the rally. So at a minimum, what I'm expecting, Blake, is that we'll see this indicator get to an oversold level below that green line prior to the CPI coming out. So that will act as a springboard for the market. And, you know, my expectation is that should be a decent trading opportunity in the first quarter. The other issue is, and the call put, I think, reflects this. Most people are like, hey, the first part of the next year could be bad, but then the second half is going to be good. And I just think that potentially we're going to see that flipped on its head, and that what would catch people by surprise is a pretty decent rally from a low in before January 12th into early to mid-February. And again, I think the economy is going into a recession. I think there's another fairly significant bout of weakness, and I think the next chart probably addresses that. So, one of the things I use, and I know those in your community use, is Fibonacci retracements and so forth.
Yeah.
This year, 2022, is really helpful because the 382 retracement for the S&P from the low of March of 2020 to high of January of 2022, the 382 was 38.15. It was one of the reasons why in April, I'm looking for a drop to 38.50. I just thought it would get down near the 382. In fact, it exceeded it going into June. After the rally in August, I think we're going to go down to 3,500, take, at least test the June low and so forth. The 50% retracement, 3,505. The 618 retracement is 3,195. So if I'm right that, okay, we may get a decent pop early in the year, but beyond that, I think as the economy gives more signs that, yes, a recession is likely coming and the Fed not bending as they have in the last 20 years, because inflation is much higher now than it has been in the last 20 years, I think the S&P has a chance of getting down towards 3,200, which is the 618 retracement. So that's my outlook, at least for maybe the first half or so of 2023.
You think that's going to be a tradable low then, somewhere down there?
Yep.
All right. Well,
yeah, because at some point, again, if this plays out, at some point in time, the Fed, gets too restrictive. They keep holding it. The economy starts to look like it's going into recession. The next shoe to drop will be that they're going to cut rates. And the market obviously will anticipate that. So I think you could have a pretty good rally in the second half of this year. I just think the way we get there is going to be different than what most people are thinking of. Because right now it's like, oh, we get a weakness in the first half and then strength in the second half. I think you could have more weakness in the first half than people maybe are factoring in. All right, this is the dollar. You can see that trend line going back to the lows of January and June of 2021. I think that trend line, I think, is going to hold. You can see at the bottom panel, the RSI, pretty oversold. And, end of year, I think, is causing some choppiness and weakness. Maybe it extends in the first part of next year. But I think the dollar is going to have a tradable low, rally towards 107, 108 at a minimum as we get into the first quarter of next year.
Okay. And so what does that mean for gold?
Well, interesting. Okay, so gold had a peak in August of 2020 at 2,070, dropped to March of 2021, where the A is. Oh. Then, to me, three-wave rally up to the high of March of 2022, which was 2,067. And then from that high, to me, it looks like 1, 2, then wave 3 did a 1, 2, 3, 4, 5. This rally over the last month or so has been an ABC. I think there's still a decent shot that gold can trade down below 1616. And that would finish the correction that began off of the August 2020 high, Blake. And if that unfolds, to me, that would be a very bullish development. And that gold would then have, I think, a fairly significant rally. Up until, right where we are now, you can see we've just been chopping in an upward fashion. So my expectation is gold is nearing a high, and I think we're going to see a decent sized pullback. And if that first part of that pullback turns out to be a 1, 2, 3, 4, 5, that would increase the probability of a drop below 1616. So the last 2-3 weeks, I'm kind of like, okay, I thought we'd have a rally from 1630 above 1750. I said time to lighten up above 1770. And I've just been standing aside because to me, it's like, okay, I don't have a clear and high conviction view. I do think that we're near a high and we're going to see a pullback that retraces at least 50 to 61.8 of the rally from 1616 to what was the high? 1750 was it, or 28? Maybe 1828. Anyway, so I think there's going to be a great trading opportunity in gold next year, especially if we drop below 1616.
Well, I'm going to say this, Jim. I've met with a lot of people over the last few weeks, everybody is bullish gold going into next year. It's
I know.
it's a pretty universal you know, obviously opinion right now, but it's something that I'm hearing consistently.
Yeah,
Now,
well, that heartens me, because I think that reinforces the idea that at a minimum, we're near a high. There's going to be probably a decent retracement to temper some of that bullishness. And obviously, if it goes to a new low, that'll wipe all that bullishness out. And again, add to the idea that there's a great trading opportunity coming if gold does in fact trade below 1616. Okay, treasury yields. You can see the unbelievable move up in treasury yields. And you know, as we were making the lows in October, you know, I was like, okay, I think we're going to get a pretty decent decline in treasury yields. You know, we're going to retrace part of the move from 252 up to the 433. When we got near 340 and the CPI came in on December 13th or 14th, and the yields, both the 10 and 30 year, did not take out their low, which was on December 7th at 3402. To me, that was like, okay, if you can't get yields to make lower lows on the CPI report, that just confirmed the bond market was overbought. We're going to see a retracement, and obviously that's what's been happening.
yeah,
I think that there's another rally coming in treasury yields. If I'm right about the economy and Fed policy and all that, I think there's a decent shot that the 10-year will drop below 340
wow.
in the first half of next year. But you know, right now I'm standing aside. I'm waiting to see okay, we need to see a lower high. In other words, we top out on the 10-year below 433.3.
Yeah.
That then, you know, in a sense, the decline from 433.3 to 340.02 was a wave A. We're getting a retracement of that for a B wave, and then I think you get another decline in treasury yields, and potentially you could make a run down towards the 250, 260. That's wave 4 of lesser degree. So there could be another good sized trade developing for next year. But you know, in the near term, it's like, okay, let's wait for the technicals to identify that the current sell-off is completing.
Well, if we did see a sell off like that in the bond market and yields are rallying, you know, that would, you would think it would give that dollar that boost that you were talking about. But you know, it's gonna be interesting, because I whenever the bond market moves, I try to figure out why the bond market's moving, and sometimes this, especially this year, hasn't made a whole lot of sense, given that, you know, we've seen the bond stock market correlation really break down this year. So it's going to be fascinating.
You know what? It's reverted to what historically has been the pattern.
Yeah.
I mean, you go from late 40s to almost the 90s, stocks and bonds moved up and down together. And then from 2000 to 2019-20, if you will, you know, they did the opposite. So when the market stocks had a big decline, bond yields came down.
Yeah.
So this year has just been kind of like reverting back to the old pattern. It's another thing that suggests to me that inflation may be more problematic going forward. And we've talked about some things that you know, could contribute to that. So again, the bond market and the currency markets, I think, are just as susceptible. Didn't even nail it on the third try.
I got you.
Yeah. You know, to misunderstanding of Fed policy. You know, to me, one of the themes has been, you've been in the business 20, 25 years. You've got a lot of experience. You've had zero experience with inflation at 9%. Yes. And the monetary policy needed to really bring that down. And I think that's spilled over to the currency markets as well.
It sure has. It sure has. Well, Jim, you know, I want to say, you know, from the Traders Summit community, you know, thank you for being here with us every single week. You're here, like, just guiding us through the markets. And if you guys and gals enjoy what Jim's doing, make sure you give him a thumbs up. Thank him in the comments. And if you have any, you know, comments about what he's covering, you know, jump in there, and I'm sure Jim will, you know, navigate around and address some of those questions or concerns you might have. But Jim,
do that.
What's the best way for me to follow your work, and how do I get my hands on your technical review?
Sure. Jim Welsh Macro Gmail if you want to get a recent issue, or go to macrotides.com.
Awesome, Jim. Well,
Just
thank you so
subscribe.
much. And
Great.
I appreciate you every single week. And I know a lot of traders do as well. So happy New Year to you and your family. We will not be here next Friday, but we're going to do a catch up between Jim and I, and we'll get that published here exclusively on Trader Summit. You guys and gals have a great New Year.
Thanks, Blake. You too.
Thanks, Jim. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.